Ladies and gentlemen, good day and welcome to the Tata Elxsi Q1 FY24-25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shashank Ganesh from EY. Thank you, and over to you, sir.
Thank you very much. Good evening to all the participants in the call. Good morning if you're logging in from the western side. Before we proceed to the call, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. Therefore, it must be viewed in conjunction with the business risk that could cause further result performance or achievements that differ significantly from what is expressed or implied by such forward-looking statements. To take us through the results and answer your questions today, we have the senior management of Tata Elxsi, represented by Mr. Manoj Raghavan, Managing Director and CEO, Mr. Nitin Pai, Chief Marketing and Chief Strategy Officer, Mr. Gaurav Bajaj, Chief Financial Officer, and Ms. Kaveri Sriram, Company Secretary. We will start the call with a brief overview of the past quarter by Mr. Raghavan, followed by a Q&A session. We would appreciate your cooperation in restricting yourselves to 2 questions to allow participants an opportunity to interact. If you have any further questions, you may join the queue, and we will be happy to respond to them if time permits. With that, I would like to hand over the call to Mr. Manoj Raghavan. Over to you, Manoj.
Thank you, Shashank. A very good evening to all of you, and thanks for joining us today for the Q1 FY25 earnings call. I hope that you and everybody in your family are safe and healthy. I'm happy to report that we have delivered a steady quarter of growth. It was a good quarter for us, especially with our transportation business unit picking up on the growth momentum. Our revenues from operation during the first quarter was rupees 926.5 crores, growing 2.4% quarter-on-quarter and 8.4% year-on-year in constant currency terms. Our EBITDA for the quarter was rupees 252.3 crores, staying flat at 0.3% growth year-on-year. Our PBT for the quarter was rupees 252.4 crores as against 262.4 crores in the previous quarter. We executed very well on operational excellence and fiscal discipline in this quarter towards bottom line performance, despite the impact of an exceptional one-off expense in this quarter. The company made a contribution to the Progressive Electoral Trust of rupees 19.78 crores for the quarter ended June 30, 2024, which is included in the other expenses. If not for this one-time expense, our EBITDA margin would have been 29.4% and our PBT margin would have been 28.4%. In terms of verticals, I'm happy to share with you that the transportation business reported a strong growth of 5.3% quarter-on-quarter and 20.3% year-on-year in constant currency terms. Our deep domain knowledge and strong focus on engaging with leading OEMs and suppliers across the globe positions us well to capture the growth opportunities in the coming quarters. Given the current challenging environment for the media and communication industry, I believe we have done well by protecting our business and increasing our wallet share among our key customers, which has resulted in 0.5% quarter-on-quarter revenue growth in constant currency terms. Our commitment to strengthening client partnerships continues as we introduce new solutions aimed at enhancing growth and efficiency within the sector. The acquisition of a strategic network transformation project from a top telecom operator in North America, facilitated by our Neuron platform, is particularly gratifying. Our healthcare and life sciences business reported a decline in top line by 4.3% quarter-on-quarter in constant currency terms. A significant delay in the renewal of certain projects with a major client in the US is primarily responsible for this revenue decline. On the people front, we are doing well, with our attrition rates declining further during the quarter. Since we normally do not add any freshers in the first quarter, the net employee numbers at the exit of Q1 FY25 is a result of usual attrition plus some lateral hirings that was done on a need basis. We will add fresh engineers through the next 2 quarters as they graduate and become available. We continue to invest in digital, AI, and GenAI technologies across our verticals, targeting efficiency and quality in product engineering, as well as novel applications of GenAI combined with domain and design expertise to solve complex business, product, and engineering problems. We are aiming to have 25% of our talent pool to be AI ready by December this year. As we step into the second quarter of the financial year, with confidence of a healthy deal pipeline, continued growth in our transportation business, and new customer wins and expansion of business with strategic customers across verticals. Thank you. And with this, we would let the floor open and we'd take questions from our investors.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, if you have any questions, please press star and 1. Our first question is from the line of Sulabh Govila from Morgan Stanley. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my first question is on the growth piece. So just wanted to understand on the healthcare customer, the moderation that we've seen in this particular quarter. Is this something which is over in 1Q and 2Q should normalize going forward, or this will see some effects in the coming quarter as well?
Let me answer that. Maybe this will have an effect in H1, and we hope to normalize that in H2.
Okay, understood. So, and the related question to that is that last quarter we had called out that we are sort of aiming to deliver revenue growth in FY25 better than FY24. So given the performance in 1Q as well as this healthcare customer moderation continuing in 2Q as well, does that outlook change or that sustains from here on as well?
No, we continue to stick with our guidelines that we talked about in the last quarter. We definitely want to exit this financial year with a better growth rate than as compared to last financial year.
Understood. And then with respect to the transportation vertical, just wanted to understand the strong growth that we've seen in this particular quarter. Is this broad-based or it's driven by the top client? In FY24, we saw strong contribution from the top client. So is that the trend that is continuing in 1Q as well, or is there a change there?
No, it's a broad-based growth across multiple customers. Some of the deals that we had closed, ramp-ups have actually started happening, and all of those contributed to this performance.
Okay, thank you. And the last bit is on the tax rate front. I just wanted to understand whatever we've reported this quarter, is the tax rate we should assume going forward as well, and for how long will that continue?
Hey Sulabh, hi, this is Gaurav. I think we indicated during the last couple of quarters that, in this financial year, our tax rate will go up because, we are coming out of the tax holiday in few of our SEZ unit. So one more SEZ unit came out of 100% bracket to 50% bracket. So going forward in this financial year, it would be likely in this range only. I think it will be very difficult to put any number beyond 1 year because it also depends upon the various other regulations and the disclosures or upcoming budget. We will see how to, position it better for the company.
Understood. Thanks for taking my questions.
Thank you.
Thank you. The next question is from the line of Manik Taneja from Axis Capital. Please go ahead.
Hi, thank you for the opportunity. Manoj, just wanted to understand your thoughts on wage hike cycles for FY25 and also the hiring plan, because last quarter when you spoke, you said we have much more measured hiring in FY25.
So the wage hikes will, we are dividing the wage hikes into the junior staff and the senior staff. So the junior staff would get their wage hikes effective Q2 from July. and the senior staff would get their wage hikes from Q3, that is October.
Sure. Is that, if I understand correctly, this is different compared to the usual policy? And if you could also give us some sense on the quantum of wage hikes and the likely impact on margins that we should expect on a go-forward basis?
The average, wage hikes would be in the range of 5 to 6%. But I think we are well covered with respect to margins and so on. We have enough levers to address that. So I don't see too much of an impact on the wage hike on our margins.
Sure. And if I can prod you further, if you could talk about how the center that you put up in Michigan last year, how is that playing out in terms of improving our positioning with global auto OEMs? It will be great to get your perspective on that.
Yeah, so all these proximity centers are important for us. Basically from a view of being closer to the customer, right? So it also shows our intent and our commitment to those markets. So from that point of view, it is very important that we take some of these initiatives. It's not just in Michigan, across the globe. We have opened centers specifically focused on certain specific customers and so on. So I think all those investments are definitely helping us, playing a role in revival of some of the large engagements that we're seeing.
Okay. The last one, if I may, while we saw when you've been talking about FY25 being a better growth year than 24, but last year transportation was the vertical which led growth, while we saw challenges in media and communication as well as to some extent even on the healthcare side. How should we be thinking about the growth mix across verticals from an FY25 standpoint?
The same. I think, from an FY25 perspective, definitely, again, growth will be led by transportation. Our industrial design, business is also showing, accelerated growth. And actually, the initiative that we started in terms of design digital and combining design with our, embedded offerings is really, really resonating with the industry, and we're seeing, good traction. We are seeing green shoots in the media and communication space. A lot more discussions happening. A lot more customer traction is there. There are, significant, consolidation opportunities that we are bidding for. So we are hopeful that, we will see a turnaround in that particular business. Healthcare, as you know, is a relatively smaller business. We have to, really work through this particular one engagement. And unfortunately for us, healthcare business is also, the number of customers is also not too many. So we have some, pretty good logos, good customer base. Unfortunately, even if there is some issues in one or two of those customer bases also, we will get hit, right? So our aim is also to broad base our customer engagements in the healthcare space. And I think we will get there, and I'm not too worried about the situation, because this is the, ER&D business. We will always have, one or two of these challenges. But I think it is very much contained, and, we should be able to recover and grow.
Manoj, if I can prod you a little bit further on this one, because you spoke about the focus on broadening our presence across some of these verticals. If I am looking at your longer term performance over the course of last couple of years, our client concentration has only gone up on account of the exposure to group companies. Top two customer concentration has gone up. What will we have to do differently to essentially reduce the concentration at our end?
No, see, if you look at it for the size of our company, it is definitely going to be, the top 10, top 20 customers will drive a lot of our revenues. There's no escaping that. There's no point to grow, focus on, a broad set of, 100 customers and each of them not being relevant, significant enough. So from our perspective, from the size of business that we have, we will continue to have a lot more focus on our top 20 customers, because that is what will drive our growth. So we want to be a lot more relevant to these customers, build strategic relationship with these customers, and grow with these customers. So that would be the focus. And I'm not overly concerned with that sort of a client concentration.
Thank you, and all the best for the future.
Thank you.
Thank you. The next question is from the line of Ayush Rastogi from B&K Securities. Please go ahead.
Yeah, hi. So just wanted to understand on the healthcare vertical side. So we are aiming to, to go ahead with 20% of the overall revenue, so or the SGS revenue. So how are we planning, or what's the strategy behind that? Because if we see in the last 2 quarters, we are reporting the degrowth in this vertical. So can you just let us know what's the strategy behind aiming to go to the 20% kind of a?
Hi, this is Nitin here. Maybe I'll take that question. I just want to clarify that the whole call out for a 40-40-20 mix was a strategy call, right? Which is to do with how do you see ourselves in the long term? How do you see ourselves de-risking the fact that fundamentally in the ER&D business, you have industry cycles. Every industry will go through a cycle. Equally, you have geopolitical risks. You will have currency mix risks and so on. So the question was, how do you manage a portfolio well? But having said that, as much as all of you are fantastic portfolio managers, you would also appreciate the fact that you would leverage an opportunity when it presents itself. To that extent, automotive and transportation is the largest growth opportunity at this time, and therefore we are not worried about it becoming 50%, for example, even as the percentage contribution of the other two shrink. But having said that, if I were to step back about 8-10 quarters back, all through COVID and a little beyond, automotive was the one that was delivering negative/flat growth, and it was media and communications and healthcare that were driving all the top line growth that we needed. Right? So to that extent, think of this as a larger, broad guideline for the fact that we want de-risking of industries. We want a little better mix of industries rather than overly concentrated industry presence. But having said that, the actual percentage of revenue contribution of any given industry at a given time will actually be dependent on the market opportunity. Right? So please treat it as a guideline.
Thanks for the detailed answer. Just a second question on transportation. So if we look, transformation is doing phenomenally well. So is it like totally driven by the top 20 set of clients, and how kind of the visibility are we gauging in for the next set of, let's assume, post 20 clients?
Yeah, so maybe I'll take that question again. So if you look at the automotive industry, you have to remember that we have a very large base of customers there. The base of customers comprises of OEMs, tier 1 suppliers, as well as some select tool software and tier 2 suppliers within the same industry, right? So it's a broad-based portfolio. In fact, we have significant depth there. Some of the challenges that we've had was also that not all segments of that particular industry are doing well. The OEMs are doing very well in terms of spend. I remember when I say doing well, I mean it from a perspective of outsourcing and engineering. So we are in a process of also carefully pruning and curtailing the portfolio and looking at how do we consolidate and grow around the set, rather than it being a question of whether we can derive revenues from a very large number. Right? So again, this is a strategy call. That the number of customers that we have is significantly higher in automotive, and it's a choice for us to kind of figure out where we want the growth to come from.
Thank you so much. Thank you.
Yes.
Thank you. The next question is from the line of Bhavik Mehta from JP Morgan. Please go ahead.
Yes, thank you. So, couple of questions. Firstly, on the transportation vertical, with the strong growth we saw this time was maybe driven by the ramp up of some of the deals we had won earlier. But how should we think about the trajectory from a sequential growth momentum perspective going ahead? Do we expect some moderation to happen, given that this was something which was bunched up this time around, but maybe some moderation going ahead? So, any thoughts over there?
I think we see a good deal pipeline and a good momentum that is there. I mean, if you ask me, I would assume that we will be able to show similar growth. I'm not sure whether we will better the growth or it will be around the same growth. So I know it is, it's coming off a quarter where we were shown, very slow growth. So I think it's good that we bounced back immediately and we were able to deliver this, satisfying performance. We hope to continue this growth. We have that visibility. It's now up to us to convert that visibility into revenues and deliver that growth. So there are opportunities, and there is that visibility that we have.
Okay, got it. And secondly, on the margin side, any reason for pushing out the wage hike? Because typically it happens over 1Q and 2Q, but this time you're doing it over 2Q and 3Q. So any particular reason? And the related question is, how should we think about margin from a full year perspective? Are we looking at flattish, or is there a scope for some expansion as well?
I think we will, continue to be within the stated, margin range,
28 to 29.
Yeah, around 28% is what, we would, essentially the way to look at it is, if you look at the entire, financial year perspective, we hope to maintain last year's, performance, maybe beat it a little bit, and all of that depends on, our revenue growth and, in the subsequent quarters and so on. So what was the question?
There are enough levers.
There are enough levers for us to manage that. Wage hikes, it's not always that, we go. I mean, we even in the previous year or the year before, we have done exactly the same, July and October. So again, we take a call depending on, from an overall, our wage budget perspective, right? We look at it and we model it and we take a call. We typically, want to be the people cost to be anywhere between 56 to 57%, of our revenues. So we do a lot of modeling, and then we take a call in terms of, hey, what is the right thing to do?
Okay, got it. Just lastly, outlook on media and telecom, are we seeing any green shoots, or do we expect this to?
Yeah, I told you earlier in the previous question also. Yeah, we see some good. I won't call it good. We see some green shoots. Definitely, there are some large consolidation opportunities that we are bidding for. And at the same time, let me tell you that that industry is still under a lot of stress. There is a lot of M&As happening. There is a lot of pressures to bring down the overall budgets and move work from high cost countries to best cost countries like India. So there are a lot of things happening in that industry. So, but however, we are on top of many of these, and there are deals in the pipeline. So we feel a little bit more confident now.
Okay, thank you.
Thank you. The next question is from the line of Urmil Shah from Aegis Federal Life Insurance. Please go ahead.
Yes, good evening. Yes, thanks for the opportunity. Just a follow-up on the outlook for transportation vertical. In this quarter, we had called out that the large deals and
sorry to interrupt. Mr. Shah, your line is breaking up in between.
Is it better now?
Much better, sir. Please go ahead. And if you can repeat the question once again.
Yeah. So my question was on the transportation vertical. In Q4 earnings call, we had said that the ramp up of the large deal would be done in Q1. So when we are talking about similar sort of growth in the near term, are there more such deals, or there are smaller deals which are expected to drive the growth? And also, when in Q4 we had spoken about the OEM share now being 56%. So is that part of the pie expected to drive the growth in the vertical?
Yeah, answering the later part of the question, yes, definitely. We see a lot more traction in the OEM space, and yes, when you look at a pipeline, it's a bucket of opportunities, right? Not everything is large opportunities, not everything is small opportunities. There's a bucket of opportunities that we are chasing, and I can tell you it's a pretty healthy bucket that we are chasing, and yeah, I think we're confident that we will be able to show good growth again next quarter.
And in the last few quarters, the transportation vertical growth has relatively been inconsistent versus what we have done earlier. So this time you are more confident that the growth should be more consistent, at least over the next couple of quarters, right?
At this point in time, sitting today, that's the visibility that we have.
Sure. Yeah, those were my questions. Thank you.
Thank you. The next question is from the line of Abhishek Shindadkar from InCred Capital. Please go ahead.
Hi, thanks for the opportunity and congrats on a good quarter. So two questions. This quarter we saw an increase in the on-site mix, presumably maybe because of the ramp up. But any color in terms of what could the mix be, or what is a sustainable level? And the second is on the headcount. Anything that you want to add in terms of the numbers of headcount that we have seen for the quarter? Is this a one-off, or the mix could keep on changing as you highlighted as you hire the freshers?
Yeah, I think this quarter we had a slight uptick in our on-site percentage, which is pretty normal, I would say, especially when you start up new engagements and so on. Customers would definitely want the initial phase typically would be on-site. A sustainable level, I mean, from our perspective, is definitely 25-75, and we will hover around that range only. From a headcount perspective, so over the past I would say 4 quarters, we have very, very diligently ramped up our resource pool in expectation of some of the large deals picking up. We see that some of these deals are really picking up now. So from that perspective, I think we are well placed. Further hiring would exactly be based on improving our utilization and utilizing the resources that we have already hired and so on. So we will, especially when you look at a lateral hiring and so on, it will be muted. However, it will be on need basis. As and when we definitely need certain skills, we'll go out and hire, but we won't be hiring in bulk, especially from a lateral perspective, because we already have built a sizable bench and we're pretty confident on the capabilities and skills that we have. Fresher hiring again, will be spread out over the next 2 or 3 quarters, and again we will take a call based on the revenue, based on the project ramp ups and revenue uptick. So we will be a little cautious in adding costs, especially engineering headcount, because we want to get back to our preferred margin, given that we had this one-time expense and so on. So we will be a little cautious as compared to the last financial year. But having said that, we will keep our commitments in terms of whatever we have onboarded the resources and so
on. Thank you, sir. This is helpful. So just to clarify, the net reduction in the employee was more about prudence rather than an uptick in attrition. I mean, I know the attrition number is flat quarter on quarter, but there is no change in the quarterly annualized attrition for us, right?
Annualized attrition actually has come down, typically, what we do is, even though we have attrition every quarter, the number of resources we add is far higher. But in this quarter, we have not added any freshers, because Q1 typically we don't add too many freshers. Even if we add freshers, it's usually in the last week of the quarter and so on that people join. But this quarter we have not added, so that is why I think our addition is also, net addition has come down. Having said that, again I say we will be cautious moving forward.
Noted, sir. Thank you, and that was very helpful. Best wishes for the year.
Thank you.
Thank you. The next question is from the line of Rajesh from Zenith. Please go ahead.
Yeah, good evening. My question is you mentioned about one-time expense. I didn't get that. Can you please elaborate on that, please?
So the company made a contribution to the Progressive Electoral Trust of rupees 19.78 crore in the last quarter. So that is the one-time expense that we talked about.
Okay. And